We also take you out of Bloomberg Intelligence sometimes to get the read on the overall market. And this time we go to Ken Leon. He's Director of Equity Research at CFRA Research, and he joins us now for Netflix. So he can pretty much talk about anything. But this time we're talking about Netflix. You know, I look at a chart of the last kind of 24 hours of Netflix. Investors cannot make up their mind what they want to do with the stock. Like now it's down by 1%. Why?
So it's great to be here. Netflix, we have a buy and a 725 target, reiterated that with our published note last night after the call. So for Netflix, it's the second time, 2 quarters in a row, where there's always a little blemish here. And it was really the guidance for Q3 for revenue, just right below the consensus target. But when you look at the full year outlook for Netflix and 2025, but for even 24, they reiterated a target of $6 billion of free cash flow and 14 to 16% revenue growth. That underscores, along with operating margins in the second quarter that widened from 22% a year ago to 27%, showing, we believe, a growth stock with solid top-line growth and increased profitability, unlike all its peers.
Yeah. So is it just like either they're going to come into tough comps in the third quarter because that's when they sort of cracked on a password sharing, or is this just a law of large numbers?
No, I think this is a solid, high-quality growth company. You know, there was a lot of sell-off this week with the Mag 7 and other issues. Netflix is a high valuation metric that we still think supports the outlook and a 725 target 12 months out. So I think particularly portfolio managers are thinking, is the fundamentals there to support the high valuation? We think the answer is yes. In my career, over 4 decades, I have never seen an industry so disruptive, which is movies and entertainment, where you have a dominant, get-it-right business model with Netflix, and everyone else is losing money and trying to figure out what is their future in the new world of technology.
Why is it so hard for Disney, Warner Brothers Discovery, Paramount to make a dent when it comes to Netflix?
It's a great question. You know, part of it is it's always difficult to transition from legacy to new platforms such as streaming. Second, it requires having talent on board to do all the hard, dirty work day by day of building an intelligent platform that gives the opportunity for global reach and customer personalization.
Do you think that the streamer, like the Warner Brothers and Disney and everything, at some point, do they wind up becoming more solid enemies, or will they always be frenemies? Geeta Ranganathan of Bloomberg Intelligence pointed out that now they're getting their content on Netflix. So they're kind of, like our streaming network isn't going to be as good, but we want our content out there. Now we're going to go and give it to Netflix. That just seems very odd.
Yeah, so the world has changed, and it's really 2 tiers of players. The new big players are YouTube or Amazon Prime Video, Netflix, and everyone else is trying to figure out, particularly on streaming, how can we play, possibly partnering, bundling, but it's a position of weakness. It's very hard for these companies for content to keep subscribers. Think about this, that if you're investing or thinking about wireless or cable TV in its good days, you had very low customer churn. None of these companies published monthly or annualized customer churn.
Yeah. So what does that tell you?
It tells you it's a very vulnerable business. You have to have engaging content. You have to have a lot of it. You need an intelligent platform in each country because cultures are different for personalization. So do we think Bob Iger, when Disney reports, will talk about getting to what I just said. Netflix is there and Disney's trying to catch up.
So at some point, do the likes of Disney pull back capital? Does Warner Brothers and Paramount pull back capital?
Yeah, so the area that there's always this yin-yang between content and distribution. And where you have the more durable, recurring growth areas for many of these companies is in content for film or TV, general entertainment. And what's stacked right above that is live sporting events.
Right.
It's not distribution for these companies.
When you pivot from live sporting events and they're on Netflix or Amazon Prime instead of, say, CBS, do advertisers pay the same? Are they making the same amount of money, or is it still sort of a model that needs to be proven?
Well, advertisers have done two things.
Mm-hmm.
In the last 10 years, they've shifted enormous money for social media, whether it be Meta, whether it be Google with YouTube, et cetera. So what's left for traditional advertising on TV is smaller, and it's being shifted to live sports. The only one, it's kind of interesting here. We have a hold, and the stock is up from like 32 to 37, is Fox. They're only live sports and news.
What do you think we're going to hear when we move forward in terms of Netflix talking about that ad-supported tier, though?
Well, what they're releasing, they said sequentially, Q1 to Q1, they had 30% growth in the ad pay plans. It's a lower rate. Mm-hmm. And advertising revenue directly from the advertising sponsors, they're not reporting it. It is reported by the other legacy media companies, though. Good question.
Gotcha. All right. So Netflix still a buy, 720, right? 720, 725?
Netflix is the winner, and they're going to continue to gain share.